Okay, for this video, I want to talk about how to report the sale of your main home and claim the principal residence exclusion. However, this is going to be a unique circumstance where you sell the home, but you didn't meet the ownership and use time period, and an exclusion applied, right? And so the exclusion that we're going to cover in this example is a change of employment. So as far as what we have in front of us here, I want to go through everything first, and then we'll come back to the slides. So I do have two slides. The first one is covering some of the background, the rules, and some simple examples as to how the principal residence exclusion works. And then in the second one, we're going to talk about some of those exceptions to the general rule, and then we'll look at the fact pattern, okay? And then in addition to those, we do have a sample Form 1040 where we're going to be claiming we're going to be reporting the sale of the house and claiming a reduced portion of the principal residence exclusion. And then we do have a sample 1099-S that the taxpayer received when they sold their property. Okay, so let's go back to the slides first, cover some of the background on this, and then we'll get into the fact pattern. So, the principal residence exclusion, what is this? So under Section 121 of the tax code, if you're an individual and you sell your main property, so the property that you lived in and used as a principal residence, you can exclude the capital gain on the sale of that property up to $250,000 if you're an individual, or $500,000 if you're a married couple filing a joint return. So generally, you have to have used this property as your principal residence for 2 of the last 5 years leading up into the sale. So if we look at some two simple examples here, which illustrates how this works. If we have Mary purchases a home for $150K in July 2018, she owns and lives in the house for 2 years and a day, using it as her principal residence, and she sells the home for $225,000. So the amount of gain that she has on the sale is $75,000. Now, Mary can use the principal residence exclusion, and she gets up to $250,000 of gain, which basically eliminates her whole taxable gain. So on Mary's tax return, she won't have any capital gain on the sale of her property, right? And that's obviously very, very good, right? That reduces her taxable income. She's not paying gain on the sale of her house. Now, what happens if the ownership period, or the use period rather, splits up a bit? So let's look at James here. So James, he buys a house in Florida for $200,000 in September 2017. He lives in the home for a year, and then he decides, well, I want to move to Washington, D.C., let's say for personal reasons. And so James keeps his house in Florida, and he rents an apartment in Washington. He still owns the Florida home. Now, after he lived in D.C. for 2 years, he decided, well, I'm going to move back to Florida, and now I'm going to continue living in this Florida house, and I'm going to start using it as my principal residence again, right? So for 2 years, that Florida home is vacant. Now, if James sells the property in October 2021 for $305,000, the total gain is $105,000. Will James get the qualified, principal residence exclusion? And the answer is yes, he will. And this is because he's owned the property for all these years, but he also used it as his principal residence, aggregating at least 2 years or more. So when we look at his ownership, he owned the property from September 15th to October 1st, 2021, so 4 years and 15 days. But during that period, how much of the period was it used as his principal residence? So he used it for the first year, right? September 15, 2017 to 18, so a year. And then the next 2 years, he was in D.C., so he still owned it, but he didn't use it as his principal residence. But then when he moved back, right, he used it as his principal residence for a year and 15 days. And so when you add up the total use as a principal residence, he gets to 2 years and 15 days out of 4 years and 15 days of ownership. So he still qualifies for the exclusion. Okay, so now what happens in cases where you did not meet the use test or the ownership test? You fell short of that 2 out of the last 5 year mark. Well, this is where the exceptions come into play. Okay, so if we look at Treasury Reg Section 1.21 3B, we have reduced exclusions available if one of the three circumstances arise. Right? So we have either a change of employment, we have a change in residence due to health reasons, or we have some other unforeseen circumstance which forces us to sell our house and move somewhere else. And so what we want to talk about in this video is the change of employment. Now, within the regulations, they have this distance safe harbor. So the distance safe harbor effectively means that if you change employment and the mileage for which the change occurred exceeds 50 miles, then you qualify for this safe harbor. All right, so the safe harbor says that change in place of employment occurs during the period of the taxpayer's ownership and use of the property as a principal residence, and the new place of employment is at least 50 miles farther from the residence sold than was the former place of employment, or if there was no former place of employment, the distance between the qualified individual's new place of employment and residence sold is at least 50 miles. So here's an example that was provided in the actual Treasury reg. So the government has posted this as an example of who might qualify for this distance safe harbor. So they have A is unemployed, owns a townhouse that's been used as her principal residence. In 2004, A obtains a job that is 54 miles from her townhouse. So she sells the townhouse. Because the distance between A's new place of employment and the townhouse she sold is at least 50 miles, the sale falls within the safe harbor of paragraph C2, and A is entitled to claim a reduced maximum exclusion under 121C2. All right, so two key points here. One, you still qualify for the exclusion. However, the second piece is it has to be a reduced exclusion. And so this is the prorated exclusion amount. So the partial exclusion is going to be based on a fraction. So in other words, you qualify for the principal residence exclusion, but you might not be able to claim the full $250,000. And so that's why we have to calculate a prorated exclusion amount. So the partial exclusion is based on a fraction, which is multiplied by the maximum allowable exclusion. So $250K for single filers, $500K for married filing jointly. And the denominator is 730 days or 24 months, depending upon the measure of time used in the numerator. So what we're going to do in our example is use days. So let's look at our fact pattern here, and then we'll start looking at the return itself. So on February 1st, 2021, John buys a house in Sarasota, Florida for $300,000. Now, John lived in the house and used it as his principal residence. After 13 months, right, so he's below the 2-year mark. After 13 months of living in the home, he starts a new job in Orlando, which is 128 miles away. So John sells his home, relocates to Orlando. The sale price of the home in March was $455,000. So he had a net gain of $155,000. Now John is asking, well, can I still get the principal residence exclusion? And the answer is, yeah, he can. Under this fact pattern, he could. Because he owned and used the home as his principal residence for 407 days before the sale, and he qualifies for the distance safe harbor, right? It's more than 50 miles away. His partial exclusion is going to be $139,500. So if we take the number of days owned and used, 407, divided by 730, we have 55.8. Multiply that by $250,000, which is the maximum he would get. So $139,500 is the maximum amount of exclusion that John could be able to take on his tax return. So let's look at the tax return itself, and we'll look at 8949 and then the home exclusion worksheet. So remember, John is selling his main home here. It's a long-term disposition, right? Because he owned it for more than a year, but less than the 2. So we have a long-term transaction that's not reported on 1099-B. It's reported on 1099-S. It's his main home. Date acquired Feb 1. Date sold March 15th. The sales proceeds from the disposition are $455,000. His cost basis was $300,000. And so the total gain he has here is $155,000. Right? So if we look at if we do just some simple math here, just so we can see what this is looking like. So $455,000 is the total sales proceeds, minus $300,000 is cost. So his gain on the sale is $155,000. But remember, the amount of his exclusion is prorated. He can't get the full $250,000. He's only allowed $139,500, and so that's why the amount of gain that he is still subject to tax on is $15,500. All right. So if we look at the primary residence calculation worksheet here, so this worksheet is very helpful in figuring out your adjusted sales proceeds, adjusted cost basis. But more importantly, what it really does, if we look to page 2, is figure out what the reduced exclusion is, right? So if we look at worksheet 3, reduced exclusion, John, if he qualified for the full amount, it'd be $250,000. But because he gets a reduced exclusion for change of employment reasons, we have to prorate the exclusion. So 407 days of qualified use results on line 5 here, right? 55.8% of the total maximum amount that he could get, and that's how we get a reduced maximum exclusion of $139,500. So when we look at John's 8949, again, he gets an adjustment for $139,500, not $250,000. Right, so he can't take the full amount, but he does have some taxable gain left over there, again, because he gets a prorated amount of the exclusion. The key takeaway here is that if you sell your principal residence, you should always be looking for some reason why you could still qualify for that exclusion, even if you sold it before that 2-year mark. And so John, given his circumstances here, he didn't meet the 2 years out of the last 5 ownership and use period, but he met one of those exceptions, right? Health reasons, change of employment, or other unforeseen circumstances. And so that's why he was still eligible for some of the exclusion. It just wasn't a full amount. All right. Okay, so that covers it for this video. I hope that was helpful. If you have any questions, please leave me a comment below, and I look forward to seeing you again on the next video. Thank you.